Hey everybody, welcome to the live stream. It is March 13th. It's about 1 p.m. Eastern. The stock market is open and the stock market is down. I wanted to begin with the fear and greed index and just talk about where we are with the economy. If anything, just the perception and sentiment, because I think that's what's really driving the stock market right now. We're not going to get out of a bear market until I think the sentiment improves, until we get some good stories, until we get some relief. Now, a big part of the fear index right now is that we have a tariff war going on. There's, both sides of each battle are escalating, and there's tariffs going out from the U.S. to another country, and then that other country is retaliating, and all that's just creating if anything, delays in businesses buying, making decisions, planning projects, those types of things, right? Now, the whole tariff thing may play out to be a very good thing for the US. Not saying that it's not going to do that or it is going to do that, but just for the time being, it's going to be a rough ride. And it already has been a rough ride for approximately 30 days. As we look at the fear index, we're at extreme fear. I think the economy is weighing on investors as they see that one more data point, Delta Airlines came out and they're seeing travelers really go away, like stop traveling. People are concerned about how much money they're going to make in 2025, 2026. So they're not taking trips they don't need to take. Business travel, especially governments, the travel really went down. So that's an index, or I should say that's a data point that shows that, hey, the economy is going to have some headwinds. So that's going on. As we look at the index itself, it's improved slightly from last week. It was at 17. 0 is the worst case scenario. Like that's just really bad. The best case scenario on this is 100, which is extreme greed. That's when stock prices are flying up and everybody thinks that it's just, you can make so much money on the stock market so easily. So this is something that I cannot argue with. I think that's what's weighing on the market. I saw a report, and this came out on The Compound, which is a show I like to watch on YouTube. And this is the Atlanta Fed. And this is being kind of debated like, well, they had some data in there that was bad and so forth and so on, but it's data. It's one quarter showing a contraction. So we can debate that, hey, it was bad data, it was good data, but let me tell you, we're going to have a lot of eyeballs on the next quarter. And if the next quarter is negative, oh man, we're going to continue on the sell-off for sure. So we are in a negative sentiment market, which is driving the market right now. The NASDAQ is down 1.84% just today. For the year, it's down 10.29. And since February 19th, the NASDAQ is down 13.56. Clearly, we are in a correction to the NASDAQ. The S&P is not doing as poorly. It's down 6% year to date. And from its high recently on February 19th to now, it's down 10%. So if it closes, I don't know if it's closed in correction territory yet, but it may close in correction territory today. The S&P isn't down as much as the NASDAQ because it has probably some of the nicer, better stocks, or I should say, very well-known major caps like the Apples and the Microsofts. So it's kind of it's more resilient. So that's pretty much in correction territory. So the stock markets are really, really struggling. And when I look at a heat map, there's only a few places where investors are kind of taking cover. Meta and Google are just really down, and they had an update yesterday. So this seesaw of prices is really interesting. Netflix is down, Disney's down. These stocks were down. Telecom, they were down, I think yesterday or the day before. That was a good, positive spot in the market. Healthcare isn't crashing and burning today like consumer communication services. Apple is really on a negative run, really bad, really down, as well as some other software companies. So Adobe's down big today. Take a look at that one later. So that's what's going on out there. Consumer staples isn't down too bad. Utilities are kind of holding it together. But healthcare is doing okay. On a day like this, it's pretty good. Amazon's down 3%, Home Depot's down. This is all, concerns around the economy. That's what's driving all that fear. Now, when we look at these sectors, which sector is doing the best today? Materials. And utilities is barely in the red. Healthcare is in the red, but just slightly. Consumer discretionary, fear of the economy going into recession, it's hitting consumer discretionary squarely. Communication services, that's where Meta, Google Alphabet, Netflix are. Technology's down. So these are really losing. For the year to date, technology's down 10%, consumer discretionary down 6.8%. Materials is doing well for the year to date. Healthcare is doing okay. Consumer staples is holding its value. So that's what's going on right now. Good place to be is materials and healthcare. And the big caps, as mentioned, Apple is not having a good time. They're down 15%. And that has a big effect overall on the stock market because it's such a valuable company. Its market cap is 3.1 trillion. Microsoft 2.8 trillion, and then Nvidia. So there's just a lot of pain out there. This whole column is red with the exception of Berkshire. So man, it is bloody out there. Today we've had a couple earnings. Futu, which is a Chinese financial services company, announced. I'd like to look at that stock. And Adobe announced yesterday. We can look at that stock. After the market closes, DocuSign's going to announce. Ulta, Service Titan, and we'll see how those announce. All right, so I've got a list of stocks I wanted to cover. Let me check the comments. We're 18 strong. Thanks for joining, everybody. Jay Zeb, thanks for joining. Sergio, good to see you. You've heard of a government shutdown. Yeah, that's another, just add one more concern, right? There's the politicians in Washington, D.C. are trying to figure out how they can keep the government open. They need to have a spending bill that they agree on and then have it pass, I think, the House, and then it moves over to the Senate, and then the president approves it, signs it. And what I have heard is that there's a lot of tension between the two parties. So it may not pass. You're right. That it may be one more thing to be concerned about. Looks like Kunal, you'd like to look at Aeromac. All right, I can note that. I don't think I've ever looked at Aeromac. We can look at it. Mike, the dividend investor guy, good to see you. If my account stays exactly where it is today, oh no. Yeah, man, there's plenty of pain to go around. I was doing really well, but this week especially took me into the negative. So, but I'm still beating the market because the market's doing so poorly. Yeah, so let me know, Mike, if you want to look at any stock in particular. So let's take a look at a couple stocks I had in mind. We'll start with Futu, which is this company, FUTU, is a lot like Robinhood, but in China. And they provide two trading platforms over in China that they go to market with. There's Futu Bull, and I think this allows investors in China and Hong Kong specifically to invest in the Asian markets. Now, China's been really working. So these guys have had a heavy trading volume. So these guys are really making a lot of money. And stateside, they offer up Moomoo, which is available here in the United States. And I have a Moomoo account, and I keep telling myself I got to get more active on it because I'm a Alibaba investor. I invest in Futu, and I have ETF. But I'd like to see if I might want to invest through Moomoo and invest in the Asian stocks. So I've been telling myself that I got to try to do that. That's what Moomoo does exactly. It offers up U.S. people access to the Asian market, which is really good. So this company here, what's interesting, they announced their earnings, and they're really growing nicely. They're growing the number of clients they have, users, and overall revenues. Revenues increased substantially in the fourth quarter, and I want to make sure I get this right. Total revenues for the year increased 35%. So they had a very good year in 2024 and very profitable year, very high cash flow. I mean, all the metrics that you want to see, they really checked all those boxes. It's a really, really healthy business. When we look at the company, it's a almost $15 billion market cap company. It is down today after they announced. It's a small cap. You're paying about 10 times revenue and a forward P of 17.55. It is a buy, but they've been really on a roll. For year to date, they're up 34%. And for the 1 year, they're up 67%. It's got ups and downs, but overall, this stock's really worked. Boy, if you bought 5 years ago, you would be very, very happy. Year to date's been really working. And I had to kind of get into the stock. I'm in a very small position, sitting on a gain right now. When we look at this company, they're growing really well. The revenues are growing nicely. And I think that the Chinese stock market, it's going to continue to get more and more interest. Chinese stocks are really working. Their economy is growing much faster than the US. And you think about how competitive China is in all these different regions of the world: Latin America, Africa, Middle East, the rest of Asia, South America. So you have China that has all these advantages and coming out with terrific technologies. They're competitive in AI. They have really good EVs. So those companies are really flourishing. And Futu is taking the Asian investor and giving them financial services, giving them a trading platform, as well as international investors that want to invest in those markets. So I think they're in a very, very good position. Trading volumes are really up. I don't think they're going to go down because China and Asia stocks are really working. So the growth is there. Profitability is awesome. Overall profit margin of 45%. That's incredible. Just really profitable organization. They remind me of Robinhood because that looks like Robinhood kind of fundamentals. Analysts, 4 of them cover it, not a lot of analysts, and they are pessimistic about this stock. I think the rise really caught everybody by surprise. They think it's, priced 20% too high. And I'm going to take their growth data, which is fairly good. The company's still going to grow their top line revenue and expand earnings per share quite quickly. So I use that in my valuation. Now, when I value the company, I see a substantial discount because they're so darn profitable that they generate a lot of cash. So when I forecast their cash, I just get a very big number, a big chunky number. I think their future cash flows are worth $33 billion. And I'm using a higher discount rate since it is out of my home country and I want a greater rate of return. So when I have that type of net present value of the future cash flows, I add the existing cash on the balance sheet and take away debt. So I have an equity value of 33.7 billion. The market cap's only 14.8, so it's really discounted if I compare the intrinsic value of cash flows versus the current stock price. On earnings per share, I think it has a decent discount, but overall, I think it's really highly discounted. Now, my investing strategy is to find excellent businesses that I really believe in that are trading well below their intrinsic value. This one qualifies, well below the intrinsic value. Now, what is important is making a decision on the business. Do I think this business is really desirable? Is it the right kind of business? Do I want to own it for the next 10 years potentially? And on the Futu business, the answer is yes. I like the Futu business. So they are geographically located in a market that right now is booming. The equities are booming in China. They're doing really well. And they're serving a market that has a organic growth of new investors. You think of the middle class that's expanding in Asia, that middle class is going to become an investor. Those investors will get accounts with Futu and they'll start investing, and Futu continues to grow. It's a lot like Robinhood is growing organically because they're really tapping into the young investor, something that they do far better than the traditional firms. So I really like Futu. They have really strong competitive advantages that I think are going to be there for a long time. Geographically, they have huge advantages because they understand the Asian marketplace far better than, American firms that would try to go into the Asian marketplace, or European firms that try to do the same. Futu will have those cultural advantages of understanding that market better. So overall, I just think very highly of the company, and I'm going to keep buying shares of Futu. Great discount. I like the business. I like the exposure to China, Hong Kong, the rest of Asia. And I think this stock's going to be worth a lot more in the future. So that is Futu. Looking at, it looks like Bad Omen joined. Very good to see you. Thanks for joining. And I'll catch up on comments in a bit. Now, one stock that is not having a good day is Adobe. The sell-off caught me by surprise, down 13.7%. The market just doesn't like Adobe. It's quite interesting. As we look at their growth, it's very good profits, 89% gross margins. This is just a really solid business, and I have it nicely discounted. I bought more shares today. I'll gladly take that discount. I think the Adobe business is going to be worth far more in the future. These guys are trading well below intrinsic value. They're proving that they continue to grow. The whole scare that, hey, AI is going to cannibalize the Adobe business, I just don't see the evidence of how that's happening. But I do see evidence that these guys are growing. I see the evidence that they're making money. I see the evidence they're generating cash flow. So I continue to believe in Adobe. And today is kind of a tougher day to, have that conviction of, do I believe in the Adobe business? I absolutely do. And I recorded a different video. You can watch it on my channel covering, my reasons why I continue to be bullish on Adobe. So I really like Adobe. It's a really discounted stock, but this market, when you have fear in the market, boy, it really reacts with a lot more momentum. In this case here, Adobe, before the market opened, it was trading probably down 4%. Now it's down 14%. It's really, really surprising This stock's down 30, close to 35% over the 1 year. And Adobe, in my book, is just a quality company, very good company. So we'll see how things play out for Adobe. It might take a while, but I think the stock's going to be worth a lot more than $377 per share. So that is Adobe. One of the things that I decided to do is, since China is working, I'm going to continue to buy into Alibaba. I think that's a solid stock, as well as an ETF, FLCH. And that's how I'm playing China. And this gives me good exposure to a long list of companies: Tencent, Xiaomi, which is just crushing it. Of course, Alibaba, JD, Pinduoduo. So I've got exposure to all these companies, and that way I could just continue to buy into this ETF and have exposure to China. So that's how I'm playing China, is I'm buying into Alibaba, I'm buying into Futu in this particular ETF. So later on today, DocuSign's going to announce, and I'll cover DocuSign late today in probably a video, independent video. All right, so let me see if there's any other new comments out there. So, Zev, keep buying Meta and Amazon. I bought more Meta, I bought more Amazon today. So Sergio, I've read a comment that says the Chinese market is basically flat since forever. Well, I encourage you to study data and not form an opinion based on what everybody else is saying. If you really look at the market, that's just not factually accurate. When we look at, let's look at Shanghai as an example. Yes, it's been relatively flat, but if you look at the last year, it's up 10.55, and you see this jump that happened in September. From this point to this point, it's up 24% in a matter of 7 months. So it's a great rate of return. So yeah, the Chinese market for a couple of years was not doing anything. There was some stocks that were really flourishing. There were some stocks that were really in a bearish market. But the Chinese market's really taken off. And another market that's taken off is Germany. And Germany is really crushing it along with Poland. Look at the, this is the DAX. This is the German index, up 25.64%. Year to date, it's up 12.7%. It's in the opposite direction to what we're seeing in the American exchanges. If you look at the S&P or the NASDAQ, they're down 10 or 13% on the NASDAQ. This is going in the opposite direction. So I think there's opportunity in Germany, there's opportunity in Europe, there's opportunity in China. And, I'm not going to, go all in on those regions, but I'm beginning to buy into an ETF in Germany. I'm buying into China, and I think it's a good idea. So far, those investments have been paying off. So, okay, so yeah, CRM is taking a beating today. You are correct. Salesforce is being sold off with the rest of the market. Really interesting day. Mike, remember yesterday I said on ZS? Yeah, you're right. ZS is dropping, but I think the whole space is dropping. It's crazy. So Bad Omen, what are your thoughts on SCHD? Take a look at that. And then Mike loves SHD. Okay, so let's start with that one there. So SCHD is the Schwab US dividend equity. Year to date, it's even, but you're being paid a dividend. And for the 1 year, it's up 3.39. I thought it'd be doing better than that. It really took a fall since the 7th. For a while, it was beginning to work, but it's kind of fallen off and now it's just kind of even. So that's interesting. Looking at what does this one invest in? Home Depot, Verizon, Cisco. A lot of Dow-based stocks, Chevron, Lockheed, Pfizer. A lot of these are like in the Dow index. Yeah, interesting. Well, it's holding its own year to date. It's pretty much flat, and you're earning a dividend collectively. Dividend yield of 3.64. It's pretty good. So, all right. Somebody asked about Aramac. And whoever, here it is it Aramark? So maybe you asked about Aramark. Aramark provides food and facility services to education, healthcare, business, and industry. Okay, these guys might be sold off. So 8.82%. They're listed as a specialty business service within industrials. So it's down 8.8%. For the 1 year, it's up 4.29, pays a dividend. Let's see the growth here, 5.84. It's been decent growth, single digit. Now there is one concern that's out there, which is there's been a lot of cutting at the federal level, and one of the cuts they're having is with the education department. They're cutting back a lot of money that's going towards there, and a lot of that money was being used to pay for like lunches for low income kids, and these guys may be part of that economy, part of that supply chain. If they are, they're probably going to see a big contraction in revenue. They produce decent cash flow, 364. Haven't grown it a whole lot over the last 4 years. Actually contracted from comparing it to 2022 or 2023. Gross margins are low because it is a food services company, and the gross profit margin is pretty low. This is not an exciting business, not my favorite type of business. There's not a lot of growth involved, not a lot of profit involved. I just don't have a lot of value for a business like this. Take a look at their balance sheet. Their balance sheet says they have $6 billion of debt and about $500 million in cash. So they have about $5.7 billion of net debt after you deduct that cash. This business just I wouldn't be interested in being an investor. I think based on cash, they're worth 3 to 4 billion, but then that debt is involved. I cannot get close to a valuation based on cash flow and the equity value of this business anywhere near 9 billion. So this would be a total pass for me. I would not invest in it. I'd rather find a business that is more exciting, that has more things going on, that can really create long-term value. That's what I'd be looking for. A business like CRM, Salesforce, it's a software company. They are growing. They're growing their business. They make really high gross profits, 77%. They're a big outfit, $38 billion in revenue. So that's a lot of cash that they're flowing through their statement of cash flows. $12.4 billion of cash. Wow, that's a lot of cash. Free cash flow margin, 32%. So their profit margin is 16.35%. They are a big, big software company. And when I value CRM, I get a nice discount in CRM. Here it is, 61% discount. That's a very good discount on a quality business, a company that is number one in their space, has a lot of competitive advantages, has a lot of switching off of Salesforce is very difficult for companies. They just will not do it unless they're forced to. And I don't think there's anything that's going to force them to get off the Salesforce. So I think it's a terrific business, and the market continues to discount Salesforce, just discounting it left and right. And to me, I'm a long-term investor. I really understand the Salesforce business, so I will gladly buy more shares. I bought more shares of Salesforce today. So thanks for the discount, stock market. I'll see you in a year or two when the stock is up at 350, 400. So the other stock that is underwater today you don't have to look far to find stocks that are losing values. Zscaler down 5%. Year to date, still in the green. So that's interesting. Now it's down, I think, principally because the rest of the market's down. Now I'm curious to see what stocks like CrowdStrike are doing. That's also down. So I think the whole space is kind of having a bad day. And then Sentinel One, Sentinel One, they're all down about the same amount. So just the market's getting out of stocks and moving to bonds, cash, just getting into a safe instrument, trying to wait this thing out, trying to wait for the US government to figure out how long is this tariff war going to last. If the tariff war lasts like 2 years, man, this is going to be really tough on the market. Really tough. If it lasts like 6 months, I don't know. It'll kind of be a shock. We'll get over it, and then the market will start to rise again. But for now, I don't see any sign that, hey, the tariff war is going to end, in a couple weeks. I think all sides are kind of digging in and getting ready to wait this thing out. So we'll see how it goes. For now, Zscaler and CRM and a bunch of stocks are being sold off. Now, back in November, December, January timeframe, I was worried that stock prices were too high, so I started to create a cash pile and a capital pile. And that pile is pretty good size. So I think I've got enough cash to last me a couple months at least. And then from there, I'll have to figure out which stocks I have to sell that are going to be sacrificed to create more capital, because this is an opportunity. As we see markets sell off, it's in a way, it's good news disguised as bad news. When we see stocks like I just showed, quality businesses like Zscaler, they had very good earnings. When you see companies like that just sold off quite emotionally by the stock market, it's giving us opportunities to buy at a discount. So I will gladly buy into that type of fear and collect more shares into businesses that I want to be a part owner in. Those include Zscaler, CRM, Adobe, Futu, DocuSign. All these businesses look really good. I even bought Meta, Google, Amazon, because the sell-off is pretty much across the board, affecting just about every stock. And these opportunities, to collect more shares of Meta at a 5% discount today, I'll take it. I think that's a terrific company. That's probably one of the most powerful companies that we have out there with a lot of momentum. So that's what's going on. So see, some new comments came in. Paco UW, you're interested in root. So let me note that. And then Mike Elevance. So we'll look at that. All right. Yeah, and I think I looked at the market maybe 30 minutes ago, and it was one of the few places where I saw green, which was in healthcare. Elevance was up. So Mike, most analysts are saying it would be okay by the end of the year, but I have no idea. Yeah. We'll see. I get the posturing, I get the negotiation, totally get it. And I also understand that people are fearful of the tariffs. I get all sides. I'm just going along for the ride. If the market wants to sell off, I'll buy. And and that's going to be my plan. So Joseph, you want to look at FTNT? Gladly, I think that's Fortinet. I looked at it recently. I think I remember thinking that it was overpriced, but we'll look at it today. All right, let's start off with Elevance. So Elevance, what's it doing today? It's one of the few stocks that are up. This isn't healthcare, and healthcare is healthcare. We're going to need it. It's doing okay year to date. One of the few places. I am really optimistic healthcare is going to work this year. I bought more Elevance today. I bought every single healthcare that I own. So Elevance, Pfizer, Oscar, CVS, Catalyst Pharma, United Therapeutics, and Halo. So I just buy. You know, hey, market's all wacky and selling off on fear. Elevance is working today. I bought more shares. And I think it's going to keep working. The PE is 12. It's still discounted because over the last 2 years, 2023, 2024, Elevance was pretty much sold off. So it's the starting point in 2024 for this stock was so low. It's still highly discounted. Even though it's going up in value, it still has a tremendous discount. It's still discounted well below its intrinsic value when we look at the cash flows that I expect from the company and the earnings per share. So Elevance is working. It's one of the few places, and I continue to buy into Elevance as well as others. In healthcare, now somebody asked about Root. So I'm not sure what Root is. So let's take a look. Root Inc. provides insurance products and services in the United States. The company offers automotive and renters insurance products. It operates direct-to-consumer model, and it serves customers primarily through mobile applications and a website. Okay. So you have car insurance and you have renters insurance, huh? Okay. So these guys are like a new approach on car insurance and renters insurance. Okay. All right. I get their business model. I understand that. It's a small cap, 2 billion. Revenue is 1.18 billion. They're not profitable, so they don't have PE, and they're priced at a premium according to the analyst. Year to date, wow, look at that, 86%. What happened? Did these guys cure cancer? So it looks like they announced in late January. And in late January, these guys really went up. They came back down and then they went up again. This is a small cap. Man, it is booming. So this is really growing. They announced at the end of January their growth in the quarter was 67%. Look at those growth rates. Wow, incredible. Very fast growth. Okay. So this business is really expanding quickly. They have a little bit of cash flow now, 195. Very good. Yeah, this business is really worth it. They're growing that fast and they sustain that growth. These guys are worth $4 to $8 billion. It's an interesting business. Now, can they sustain that cash, right? Free cash flow. Yeah, they've had 1, 2, 3, 4, 5, 6 consecutive quarters of positive cash flow generated. That looks good. Looks really good. Yeah, these guys just back of the napkin, I would multiply 195 times 30, and I'd probably get to 6 billion. And they are a $2 billion company. So there's a lot of upside available in this stock. Balance sheet, they have more cash than they do debt. Now they're cash positive, so they're not burning their cash anymore. This is a really interesting little company. This thing could really go places. it's already gone places. It's been to places. It started like really low. It's up 200% in the 1 year, which means they were a $1 billion market cap company a year ago. Now they're a $2 billion market cap company. I wouldn't be surprised if these guys, now they did IPO and they're supposed to, set the world on fire. They collapsed, which is typical of IPOs, and now they're up again. This is a really neat little company. I want to keep track of this one. I could not argue with an investor that said, "Hey, I'm really interested in this stock." I'd be like, "Yeah, I could see why." I think their value is very high. It's all about execution. They have to keep growing at those rates. They have to maintain their profitability. Let's see when they're supposed to be profitable. So it looks like they're supposed to be profitable next year. This year, they're going to be operating at a loss earnings per share. But next year, they're supposed to operate at a profit, and then their profits are going to triple. That looks great. Everything I'm seeing on this stock looks positive. So Root looks really good. So good luck with that. I'm going to try to keep it in my radar and keep up with it. So that was Root. Good one. Oscar Health is selling off like nobody wants it. What is going on? Oscar Health, PE 17.63. These guys are a little bit like Root. They're focused on a part of the market that other insurance companies don't want to focus on, and that's small businesses or individuals. And maybe it has to do with what we're hearing with the U.S. government, that so many services are being cut back. I think the individuals that are lower income right now, they have subsidies to buy their health insurance. And I think that's what's holding back the stock. So that's the story out there. So moving on to Fortinet. So Fortinet, let's see what they're doing today. They are down with everybody else in cybersecurity. Cybersecurity has a lot of competition, right? We've got like 10 companies trying to compete in there. These guys are probably a little bigger. They're bigger than CrowdStrike or Zscaler. They're growing at 12%. The last quarter, they grew at 17%. Looks good. And one second. I just got a text message from Coinbase. Let me make sure everything's good. Okay, I think it's good. All right, so back to Fortinet. Fortinet is a good business, and what I'm seeing is some good businesses, just their stock prices go up too high. This one, if I recall, they have good cash flow. Cash flow is 1.8 billion. It's grown nicely over the last couple of years, although from 23 to 24, the growth wasn't all that great. They do have good revenue growth, very good margins, very good gross margins, net profit margins. Now, when I look at this stock and I think about they're generating about $2 billion of free cash. They're growing in the teens, right? 12%, maybe 13. I would value these guys at like 40 billion, maybe 50 billion, and they're way up there at 72 billion. And they've been okay this year. I mean, just down 1% isn't bad, but over the last year, they're up 31%. They've been really high. I mean, their valuation has really gone up, but the fundamentals have not really gone up 500%. You saw their cash flow is kind of just small growth from 2023 to 2024. Well, if you're going to go up 500%, you really got to have your fundamentals go up in a similar trajectory, or at some point, the stock price is going to be way too high. And that's what I think is the case with Fortinet. You have a lot of options within cybersecurity. They're not the only game in town. There's other software companies. I think CrowdStrike's overpriced. Fortinet's overpriced. Palo Alto is overpriced. But other stocks, I believe Zscaler is discounted, so that's why I'm buying Zscaler. And that's my story on that stock. All right, so we're getting more people in the stream. Thanks so much for joining. Let's take a look at these comments, see what's going on. So we talked about Fortinet. Zim is having a bad day. Yep. You know, Zim announced, and I thought their earnings were really good, but the stock sold off. Wasn't that weird? So bad omen. Quick question about any stocks dividends. So on the dividend, you have to study the ex-dividend date. Maybe we'll take a look at the ex-dividend date on Zim. And I can kind of speak to that. Paco UW. Why do you multiply times 30? So I'm doing back of the napkin, right? When you look at, I think I was talking about root, right? Okay. So for like a company that has maybe they're growing 2%, 3%, very slow growth, but they're cash positive, I would multiply like times 10 because that's basically where I'm going to land if I value the company because the growth is so little. If they're growing like 10%, 12%, I'd probably multiply times 20. But if they're growing really fast, which is the case here, I'd probably multiply times 30 or 40, okay? Because they're growing so fast, the free cash flow is going to grow at a very fast rate. That's why I multiply times 30. So I'm doing that in my head because if I do a full valuation on every stock that comes up, I'd have a 6 to 8 hour live stream and I'd be exhausted. So I kind of do back of the napkin, kind of see, oh, okay, that one is probably going to land around here. And that's why I do a 30 there. Not meant to be any kind of lesson to anybody. If you are a paid member, you get access to this model that I created. And then we have calls on weekends. We go through, and I hope people learn how to discount free cash flows, how to create their own forecast of free cash flows. Because really, investing is about having a solid foundation of evaluation and then using your knowledge, your experience, and make qualitative decisions on a business. Do you think it's a good business? Do you think it's a bad business? But you got to establish that skill set in order to be at that point as an investor. So keep that in mind. If you really want to learn this stuff here, become a paid member, excuse me, and you'll have access to more knowledge and the tools. All right, so thanks for asking about that. Sitpex 2000, how are you? Till the end, how are you, sir? Google is trading really low, man. What's going on? So let me take a look here. So Google Alphabet, I bought more shares today at 18, right? And these guys continue to grow. Isn't it awesome? They're so big, 350 billion. Oh my God, 13, almost 14%. So which means they're growing like $40 billion of revenue per year. Like we saw Adobe, they grow more revenue than all of Adobe. Huge company, huge value. And these guys have terrific free cash flow. And I heard a very good, I was listening to this other channel this morning when I was in the gym, and they were talking about one of the investors that was on that particular conversation went through graduate school. And in graduate school, they taught them to manage a good investment. Classically, when you see oil companies go through a capital investing cycle, meaning they have to invest in the refineries, they have to invest in drilling for oil, they are deemed to be really bad investments. You get out of those investments, you get out because the capital they deploy shrinks the free cash flow. It makes free cash flow go away. And he was associating that. What he's observing is a lot of these tech companies like Google, Microsoft, Amazon through AWS, they're doing the same thing. They're using too much capital. They're shrinking free cash flow. And he made the conclusion that he was taught in graduate school that you're supposed to stay away from spaces like that. Now, it's not exactly, it doesn't exactly translate over from oil businesses to technology, but I think there's relevance there. I think he's making a point. The point was made with me that, hey, if you're going to invest more in CapEx, you're going to shrink your free cash flow. Google, you're not as desirable anymore. AWS, Amazon, you're not as desirable anymore. Microsoft, ditto. So those guys have to get the signal and stop spending so much free CapEx. Having said that, the price of Amazon has really come down. Let me go here because I like this charting tool. So when we look at, Google Alphabet's down 14%. It really started here, and it's down 21% since February 4th. And they announced, and then the stock sold off. So, hey, people that run Google, I hope you got the message. Stop spending so much CapEx, or you're going to keep going down. In the meantime, I'm buying more shares because I think they're going to get the message. Again, a qualitative decision. I make that decision because I know Google is run by some really smart people. And I think the stock's discounted by 38%. So I bought shares today, and I'll continue to buy shares. If the pricing stays where it's at, or even better, if it goes down, I'll buy more shares. So I'm right there with you. What you're seeing, an 18 forward PE on one of the most valuable, one of the most important, one of the most powerful companies that there is out there. So very interesting situation. All right, so shadow guy. Yeah, the market is jittery. It's a little scared, and it's jumping around, discounting companies. And here's Mike, the dividend investor guy. You must own the stock before the ex-dividend date. If you buy on the dividend date, you do not get the dividend. You have to buy a day before. Okay, that's very important. So study the ex-dividend date. Good to see you, Mike. Thanks for attending. So Justin, I guess it's Justin Oldney. You like ASPN, or you're interested in ASPN? All right. Then Joseph, I didn't have an intrinsic value on Fortinet. I could just tell you that based on where they're at, back of the napkin, they're too expensive. I don't even want to spend time doing a full evaluation to arrive at. See, it was really expensive. I've got experience looking at CrowdStrike and everybody else. So GMAB has been getting a lot of attention. It's a small company. It's supposed to be a lot like Uber or DoorDash. Take a peek. Till the end. Meta's coming down nicely. Yeah, I'm buying more Meta. Meta's priced even better than Google. It has great fundamentals. So take a peek at that. And Sergio, you're not worried about Google. I'm not either. They just need to adjust. The market clearly told you don't spend that much CapEx. The whole AI space, right? Like Adobe's doing a good job building out AI apps and experiences. And the market doesn't care. Like, who cares that you created that? And customers don't really care either. I mean, who's buying AI? Where is AI really being used? I don't have any great examples for you, nor have I seen any. So that's really the big story is AI going to be real for 2025. If it's just going to be an idea for 2025, then I think the whole space is going to deal with a correcting market, and it should. It's not like, hey, we should continue to invest on a story that never materializes. All right, so let's take a peek at Meta. Meta is nicely discounted. It's a superb company. Even though market's been terrible, these guys are still slightly in the green. They were up 25% for the year in 2025, and then they kind of gave all that up. It looks like a nice, beautiful volcanic mountain. They're a $1.5 trillion company, forward P of 23, strong buy. It's a buy for me. It's discounted, terrific business. And their growth in their primary businesses is really good. I feel like I'm buying stock at a discount of 54% when I compare the intrinsic value of the business compared to its current stock price. So for me, Meta is a buy all day long. All right, so Zim announced earnings. They had very good earnings. It's down to $18. I told myself to buy it at 17. And when I said that a couple of days ago, it kind of felt weird saying it because they had very good earnings. I think they had good earnings yesterday. Year to date, it's down 16%. For the 1 year, it's up 55. I bought back here, made some money, got out. So how could I do that again? I'm waiting for the stock to get to like 17 because they pay such a terrific dividend. Now the ex-dividend date is December 2nd. That's behind us. So we got to look at the next ex-dividend date. So keep that in mind. If you bought, you have to study the ex-dividend dates. I think on the earnings announcement, they put it on there. Ex-dividend date is this date. You have to buy one trading day ahead. Okay. Remember that. And these guys here the stock's been coming down, stock price. I think Zim's always discounted because the market does not value shipping companies all that well. Forward P is 5.72. So my intent with Zim is buy it at around 17 and then sell it at around 25. Just go in, nice rise, sell it. If I hold it for 6 to 8 months and I get a dividend, that's great. But that's going to be my game plan on Zim. So that is Zim. Zim, you can't value like we just valued Meta and Google. They just don't get valued like that. The market doesn't appreciate shipping stocks like it appreciates these other very high premium names. Okie dokie. Somebody wanted to ask about ASPN. Aspen Aerogels designs, develops, manufactures, sells aerogel insulation products primarily used in energy, industrial, sustainable insulation materials, and EVs. Okay. Wow. Yeah, we got a real declining stock price. So revenue's slowing, but revenue's been really expanding. Now, the car business isn't doing great, right? The EV market is slowing down, but as a whole, I think more EVs are being sold. Just the competition is becoming more fierce. Like Tesla has a lot of competitors now. These guys are growing. It's interesting to see where, which ones are their customers, because they're selling to like Tesla and Chevrolet, Ford, Volkswagen, and so forth. These guys don't have free cash flow. Yeah, man, that's too bad. Yeah, so they don't have cash flow. How about in the quarter? So they just started generating free cash flow, so it might be early. Now their gross margins are decent. They're an industrial company supplying into the automotive industry. They're very high growth. That looks interesting. They are profitable now. Huh. Yeah, this isn't my favorite space to invest in. industrials, building materials. But this one looks interesting. 566 million. If they turn this thing around, this thing's going to really reward investors. See how it went up here? And this just happened in 23 and then it went up. You can really see this stock take off. Take a look at their balance sheet. Make sure these guys don't have a bunch of debt. So no, they have more cash than debt. Now they're generating free cash. This is a good stock to do some more homework on. This one can really be a winner. So I'm gonna do some more homework. It's just a little too early to tell. It's a little too early to tell. They just became profitable. The market's selling off, really selling off. Wow, man. But it's really discounting this stock. So look at the discount. Analysts are like, oh, it's discounted by 236%. I'm not disagreeing with them. It could for sure be that kind of discount because they have the growth. Now they're generating free cash. The marketplace is there. Everybody needs to insulate their EVs with their materials. So that's really interesting. I'm going to do more homework on that. My opinion on that is that could be a big winner, but it's risky. These guys are really small. The market doesn't like them right now, but it might be a really good opportunity. So that's my comment on it. Now let's take a look at GMAB. So Genmab, biotech company, develops antibody-based products and product candidates for the treatment of cancer and other diseases in Denmark. Okay. There's a lot of good choices in healthcare right now. These guys are biotech healthcare in Denmark. And they have $13 billion market cap company, PE, forward P of 14, really highly discounted. Nice growth, very nice growth. And they have good free cash flow. This is in the Danish DKK, right? DKK, yeah. So very high gross margins. They probably license most of their patents out to other drug manufacturers. Very high free cash flow. So it looks really good. I just have other choices in the US. The choices I have are like Catalyst. This is an American company, $2.5 billion in market cap, growing really nice and profitable. Stock's really working, high free cash flow. This is my choice in the US, and I'm going to stick to this one. And I also have United Therapeutics, which resembles Catalyst. So there's really good choices in this space. These guys are in Denmark. So I'd rather go to Catalyst because they're in the US. That's my home country. I'd rather invest in a stock that I have, fewer risk levers, like outside my home country, riskier. I don't understand Denmark as much as I do in the US. And these guys, for somebody that's in Europe, this might be a really good idea. Really good idea on a stock. They're doing really well. How are they performing? Sold off for the year, down quite a bit. So you have your homework cut out. You have to make a decision if you think these guys are going to continue to grow, become more profitable, generate more cash. If so, this may be a really discounted stock. For me, I have choices in the US that I'd rather go with since I am located in the US. So, all right, so let's kind of wind this thing down. Let's see here. Mitch Juncker, Genmab is a healthcare stock. So I've been trying to look at stocks, how you look at them, and I don't understand. And I'm going to put you guys on hold. I'll be right back. Hey guys, sorry about that. But I am back. All right, so we were talking about Genmab, and I think the question was, how do I value a company like Genmab? And I'll take you through Catalyst if you like, and kind of walk through the logic there. Who asked that question here? I think it was Mitch. And when you look at a stock like Catalyst, and Catalyst is in the same industry, they do something similar. And Genmab and Catalyst are biotech pharmaceutical companies providing drugs. In the case of Catalyst, people that have these rare diseases and they need these particular pharmaceuticals. And I put their cash flows that I expect into a cash flow forecast. And then I discount that cash to today's value using a discount rate. Since it's a smaller company, riskier, it's a higher discount rate versus, let's say, a Meta or a Google Alphabet, 10% versus Meta, I think, had a 7.5 or an 8. And then you get a present value, net present value. If you don't know what net present value is, Google it. And if you went to college and took finance courses or accounting courses, you know what that is. If you don't, you need to learn it. If you're going to be a good investor, you have to learn these skills. If you want to be a long-term investor, if you want to follow in the, in the path of Warren Buffett, Bill Ackman, Michael, all the great investors, you have to have that skill set. So look at those different valuation techniques and try to learn them. If you become a paid member and you attend weekend sessions, we go through this stuff. It helps you learn. So we get innate present value of all those cash flows. I add cash, take away debt, then I get to a equity value. That's what the company's worth. That's their intrinsic value. And right now, this company, their market cap, which is all the shares that are outstanding times the stock price, is 2.4 billion. So it's 117% discounted if you compare the intrinsic value versus the stock price. That's what I do. That's what I would do with Genmab. Now, why would I not invest time into it? Because I already invest in 2 companies stateside. They're in my home country. But you can do the same thing for this company. And you just have to go through and dig out their free cash flow, put that free cash flow. This is in a foreign currency. That's why it's so much higher. Put it into a model, forecast that cash, make your best estimates, and then discount it. Then you could say, hey, this business is discounted by this amount. I'm optimistic you're going to get to a discount on this company. Then you make your decisions. So that is a response to your question. Okay, so Joseph, is Meta overpriced? No. We just went through it and it's discounted. Joey, why is their dividend so high on Zim? That's the Zim business. The Zim business is very, very profitable, and they don't accumulate that cash on the balance sheet. They provide these big dividends. The other thing about the Zim business, it's a shipping industry. They'll have a year when they make a lot of money, a lot of profit, and they'll have a year when they don't make very much. On the years when they make a lot of profit, they have huge dividends. And that's why they're seeing this big dividend. They made a lot of money. But you may be a year from now, 2 years from now, in a period where they didn't make a lot of money, you don't have very many dividends. So that is why that's going on there. Good to see you, Joey. Justin, I'm not sure what that stock's about. Good to see you. So you are looking at a stock INO. D. Okay, we'll see. We'll see if I have time on that one. So Tomas, good to see you. Carlos, yeah, I was out for a few minutes. I had to take an important call. Tomas, thoughts on DAL? What is DAL? Will Stevens, NTRA. Trader Prad. Market going to zero. Man, all right. I'm going to sell every stock that I own because Trader Prad said it's going to zero. All kidding aside, good to see you, Trader Prad, and thanks for the humor. Appreciate it. All right, so let's round off these last three, and then we'll call it a stream. Thank you so much, everybody, for joining. Thanks for bearing with that little break that I had to take. So INOD is INO Data, operates as a data engineering company in the US, United Kingdom, Netherlands, Canada, internationally. It operates through three segments: digital data solutions, Synodex, and agility. Okay, so they're placing themselves as an AI company, even though they started in 1993. So they probably just changed their description. Hey, AI companies get a better valuation, so let's change our name. And they certainly got a nice valuation. Yeah, 626%. So 1.36 billion. Revenue, not bad. They're like 10 times revenue, not bad. Actually, 9 times. They do make a little bit of money. That looks good. So their revenue really went up. Wow, really impressive. 96%. They were just kind of growing a little bit and then boom. That is interesting. So they do perform, they have free cash flow, 27 million. Gross margins are 40%. Why are gross margins so low? Okay. So again, here's my multiplier, right? So 27 million. If you multiply it times 10, we get 270. So if this was a slow grower, it'd be worth like 270 million. This is a fast grower. Maybe multiply it times 30. I'm going to get up to about $900 million in value. If I multiply this, round this up to 30 times 30, 900. And that's as far as I think this thing is worth. It's up to 1.36. They're in kind of a really hot space that is kind of collapsing, right? The whole data center build out is kind of collapsing on its own weight. It was a slow grower for a while. Now it's really growing. So this one here is interesting, but it's really priced expensively, right? It's up almost 4,000%. Do you want to buy it at 43 and then watch it go to 20? Hoo-hoo, that'd be painful. And that's most definitely what can happen. They don't create a lot of cash. So that's my biggest concern is you don't have a track record of creating a lot of cash. Your margins aren't very high. These are pretty low margins. We saw Adobe was at 89% margins. So low margins concern. Maybe a quarter or two more of data might give us a little more confidence that, hey, these guys are the real deal. They're doing great. Their cash flow is not a lot. So I'd pass on that one. All right. So that was INOD, DAL. So Delta announced that travelers are not traveling. Down 29%. Holy smokes. Look at that. Up nicely and then slam. Wow. So February 4th, $69 stock. Now they're 43. Whew. Brutal. The travel industry is getting hammered. And their growth was pretty decent, right? For a while, they grew really nice because the COVID year was horrible, right? The airlines couldn't travel, so couldn't fly people. So the revenue really contracted. And then they grew nicely. But now, I mean, I'm not optimistic the airline's going to be any good for the next couple of years because the economy is not good. People are not feeling confident. When people are confident, they'll book that vacation. They'll book, hey, I'm going to take my kids to Disney World down in Florida. They book the vacation. Hey, I'm going to go to the West Coast and take my, take my girlfriend, wife, my family out west and do some nice, fun traveling. So that kind of stuff is really up in the air, and that's why this stock is really collapsing. And I would not touch Delta, I would not touch United, I would not touch any travel stock of that type. I actually sold probably a third of my Airbnb stock. I started selling it a month ago, maybe a month and a half ago, because I just sensed that the travel space is going to get bad. It's gotten bad. It's going to get worse. So I'm going to hold on to my Airbnb stock, the ones that I have, but I'm being careful. I used to own United, and I'll tell you, United might be the one stock. Well, I always have stocks that I'm, disappointed I sold it too soon. So I tracked United and I thought United is going to be worth a lot more. So I bought shares, call it in 2022, and I held them for a while, and I ended up selling with like a 30% gain, like around here. Well, they went up much higher. I'm like, oh man, I sold too soon. Left some money on the table. But now I don't feel so bad because I only left because I would have probably held the stock because I'm like, see, I was right. Because they do generate a lot of cash flow. And I did see the growth in revenue, especially I thought United was the best one out of the pack. But now, I mean, the forecast for the airlines is horrible. I would not touch United. I would not touch Delta. I would not touch Southwest. No, thank you. We got awesome companies on the stock market that are selling off. I mean, look at this bonfire. Everybody, you can warm up your hands if you put them next to your screen. It's so red. You got Apple getting shellacked. You got Amazon getting beat up. You got Google, Meta, Home Depot, Costco, Eli Lilly. So if stocks of that quality are getting hammered, airline stocks are going to get smashed. So no, thank you. All right, so that was Delta. All right, I think we're going to be able to close the show out with NTRA, unless the paid investor wants to look at a stock. I'm willing to look at it for a paid investor, but I think after this one, we're going to shut it down. These guys are doing well for the year to date, 12% down. Interesting. What do these guys do? So Natera is a diagnostics company, provides molecular testing services worldwide. Its products include panorama and non-intrusive prenatal tests that scores for okay. So it looks like they do some screening for pregnant ladies. Okay, $18.8 billion market cap. It's in healthcare. You guys, I'm sorry, I've said it 1,000 times in the last 3 months. I think healthcare is good. These guys, you're buying them for 11 times revenue. They're not profitable yet. Strong buy. They are growing very nicely. Very impressive. Again, healthcare. You see these kinds of growth rates in technology, people go berserk. Oh my God, this is the next Palantir. Boom. It's worth 10 times more. No. In healthcare, it's like, wow, look at this growth. Awesome. And it doesn't go up like it goes up in a tech space. But these are like tech-like companies. Their margins are awesome. They have barriers of entry, which are patents. Their gross margin here is 60%. As they get bigger and they get greater scale, that margin is going to go up. They only have to build certain things once, and then they can get more units through it. So as they get bigger, that margin is going to go up. Free cash flow, $69 million, and they went from negative to positive. Very nice. All right, I'm going to multiply that times 30. High growth. So let's round this up to 70 so we make the math a little easier. 70 times 30 is 270 times 30 is 2.1 billion. If you guys followed that math in your heads. And it's way above 2.1 million. So investors are really buying on the fact that this is a growth business. I can't argue with that. That's just not the investor I am. I'm excited about growth, but I need to see fundamentals that are going to show me the value of the business. Right now, it's a little early. So if I can get another year of data, this one might be ready for my investing, process. And I might be an investor maybe in a year. But for now, it's just the free cash flow is just beginning to get established. Their margins are beginning to grow. Those things look really good, but they already have a pretty high valuation compared to their cash flow and so forth. And again, I can go to Catalyst, and I got a winner here. This is a lower market cap with a higher revenue. So I'd rather buy this one. This one also grows. It has free cash flow. It's doing great. 5 years, 612. Look at the chart also looks nice and consistent, right? Where this one is a little inconsistent, up, down, up. So investors got a little scared and then they went away. So I'd rather stick to this guy. It's the horse that I'm riding. I think I'm going to be fine with Catalyst. I wouldn't be surprised if these guys are a home run in the future, but right now they're just too risky for me. So thanks for asking. I hadn't looked at that one. And it looks really interesting. All right. So Trader Prad, good to see you. Good luck with your stream. Good luck with your trades today. Solidity, good to see you. Thanks for commenting on X. It is my first time streaming on X, by the way. Thank you very much for watching on X. Rotel and cheese. The marker is forward looking. So are we going to experience something like 2022? Maybe. Possible. We're down on the S&P. On the S&P, we're down the first 10%. Can we go down another 20%? It's possible. Like 2022, it took like about a year for the S&P to lose 25%. And you see how it was just, at like month 9 in 2022, it was like, enough already. God, man, I'm tired of looking at this, down market. And but that was actually the best time to buy, is when everybody was walking away going, I can't look at this stupid market one more time. It's just too depressing. Right now, we're like here. Okay, the market started to go down. See right here, this little move. We're kind of like here. We're month 1. If it's going to go down like 25%, it's going to take like 9 months, 10 months. So I hate to be the person to tell everybody knows, if we're in this thing for like 9, 12 months, it's right now is going to be, fun and games. If I do a stream in 9 months, it's going to be pretty depressing. If we're still down, like, oh my God, stock prices are horrible. This is how much this stock is down. This is how much this stock is down. But that means it's a great opportunity, because you can buy stocks and then ride them up. You can ride up, like Meta is up 600% from that point. Netflix was a huge winner. I can go story by story by story. So it most certainly could be the beginning of a massive correction. Could be. Or a month from now, the government says, all right, we made peace with all these other countries, and the tariffs are not going to be something that's going to happen any longer. And then we're going to have a rally, and we're going to be okay. Inflation, is under control. That's really good. The Fed is going to discount rates. That's going to be good. This economy, if we stay in a tariff battle for a while, we're going to go into a recession. There's no doubt in my mind, because there's going to be a lot of both individuals and businesses that pause. They're going to be like, hey, I don't want to spend anything right now because I'm nervous. And if you're a business leader, you're like, we don't want to overinvest because, let's say the tariffs go away and we committed $30 million or $100 million to build a factory here. Well, great. We're going to go back to sourcing our product from China and some other place. And now we just have to write off this $10 million, $50 million. Or people are like, hey, if tariffs are coming and more people lose their jobs, which there have been a lot of layoffs, right? I think people are going to be careful with their money. I think we could see a prolonged correction. We'll see how it plays out. All right, so that was Rotel and Cheese. Sergio. Yeah, I'm sorry, I'm not going to cover Micron. Levy, Arrowwood, excellent Hey, thank you for saying that. It's very nice of you. And then this was a, yeah, I appreciate that, Paco. Really, really nice of you to say. And there's some stocks that I can't cover, guys. Micron's one of them. I can't cover it. I have a business relationship with them. I can't comment on that company. So that's the reason, Sergio. Don't take it the wrong way. Thanks. Rotel and Cheese. Real money's made in the bear market. It's like real men are made in the bear market. All right, guys, it was an awesome stream. Let's hang in there. This is not fun. Let's not pretend it's fun. Yeah, hey, it's fun to see our portfolios get smashed. But there is a little bit of hope here. The market did pick up a little bit. Okay, that's good. It was down, God, about 2%, right? Jeez. Man. And there's no real big story that is positive right now. Everything's just negative. You got tension with the government yelling at other countries, and you got a war that's trying to be ended between Russia and Ukraine. You've got a lot of cuts at the federal level, which may cause a lot of services to go away from people. Just a lot of stuff's happening. A lot of things to be afraid of, and the market certainly is showing that. So we'll see what happens. All right, everybody. Let's kind of end it there. Thanks so much for watching. Become a paid member. I'd love to chat with all of you on weekends, hear your voices. We talk about stuff. We kind of do knowledge transfer, kind of learn to be better investors. I welcome you all to become paid investors. You can get the details on the details of this stream. You can go to my channel and get the details there, and hopefully you can get signed up. With that, everybody, take care. Thanks for joining.